Hello, thank you for joining our third quarter 2021 update. My name is Luke McCarty here with McPherson Financial Group. Let's jump right in. So looking at the economy, right, we're going to start here, then we're going to go through some annual performance, some, what we see in the markets, right? The markets tend to be softening a little bit. We've seen our first real pullback of the year, right? The S&P 500 down about 5% in the last month of September. But that being said, our economic indicators are all positive for the first time this year. So historically, when this has happened, we have good market returns going forward. Now they're set to change at any given month. But if you remember our rules that we set in place for this is that if 2 of these are negative, we reduce risk. 3 are negative, even more risk is reduced. And then, 4 or 5 are negative, then we're looking at, an 0809 event. So from the economy perspective, things are going really well. Annual performance. So this is from, these are our mutual fund and ETF models. So when looking at these, right, you can see our max growth at the top, down to our municipal income at the bottom. The far right column is 2021. So currently, right, our balance growth 65 is the furthest away from its benchmark at the moment. Max growth is catching up even more. Balance 50 is doing extremely well. Conservative 30. Still positive, right? Of course, almost 2.8%. Multi-asset income. If you are in our income model, 0.49 doesn't feel that great, but the index is negative 1.67. And the municipal income, right? We're over 2% for the year, where the index is 0.34. Getting into our more aggressive models where we own individual stocks, right? We're up a little bit over 8% for the year. Right, fell off quite a bit this last month. Enhanced dividend model, still up 11%, still our top performing account. This holds a lot of blue chip companies. It does hold some energy names. So energy is doing really well this year, right? Some ExxonMobil, some Chevron, some dividend payers. Some of those are also in our equity income balanced model, which has almost doubled the index performance. So 8% versus a 4%. 65 stock. Still the account that's struggling a little bit, and then 50 stock is doing pretty well. So quarterly comparison, I wanted to show this, and we're going to do this going forward, of how we compared each quarter versus the benchmark. On a quarterly time frame, it may be a little too much. Maybe we'll do some year over year, but I think it's good to see how we're performing in the sections of the market where we kind of underperformed a little bit. Are we catching up? Are we struggling? What do we need to do differently? If you look at max growth there, top left, right, we were actually positive for the quarter, just barely, while the benchmark was down almost 1%. The stock model, we were down, 0.14%, while the benchmark was down 0.88. So we're catching up to the benchmark. Looks like our balance growth 65 took a little hit from, some of the aggressive positions in there on the 65 portion of it. Enhanced dividends doing really well, right? Only down 1 versus the index being down 2. You can kind of go down the list and see what's doing well, what is, how things look from Q2 to Q3 versus the benchmark. All right, intra-year declines. If you remember one of my last videos, I said the market was kind of boring. It was melting up. Not anymore. The market heard me, right? The Google cloud told the market to do something different, but we're getting quite a bit more volatility now in the markets. This is your intra-year declines of the S&P 500. So despite an average return, despite average intra-year drops of 14%, annual returns were positive in 31 of the last 41 years. So year to date, right, the S&P is up about 15%, with the biggest intra-year decline of 5%. So you can kind of see these red portions of the market as the low point of the market for that year. And then the actual bar chart is where the S&P ended up for the year. So almost every year you can look on here, it looks like there's been at least some sort of drawdown where the market didn't end up there, but it did touch that point, right? Look at last year. It was down 34% at a certain point in time, ended up being positive by 16. So that's a big fluctuation there. So what we're seeing is something similar to maybe 2019 or maybe even 17, where there's not a big drawdown and still producing good returns. We'll see how the Q4 ends up. Another piece here is called time, diversification, and returns. So if you look on the left here, I wanted to show you guys this chart. The left is showing any 1 year performance, right? Stocks in green, bonds in blue, a 50-50 portfolio in gray. So any given 1 year since 1950, right, you can have a wide range in stocks, right? If you just do bonds, you have a not as wide of a range in bonds, right? Not as much downside. And then the 50-50 kind of blends the two. We'll look as you go further and further to the right? The 5 year rolling 5 years since 1950, you have not had a negative 5 year period if you did 50-50 bonds and stocks. The 10 year, right? Now bonds have been positive, and then the 20 year. So depending on your time horizon, right? This is why we want to know, when do you plan on using the money? What's your time frame, right? What are your goals with the money? If you have a 10 or 20 year time horizon of not needing those funds, well, we should be more aggressive because the odds are in your favor historically, right? The last 70 years, but any given 1 year, right? It's across the board. So I wanted to show you guys this just so you can kind of see what we look at internally when we start making decisions of how aggressive to go in your portfolios. All right, portfolio changes, right? I mentioned this in our last video, right? We increased our position in Swan, right? We're getting out of bonds. We added some more JP Morgan hedged equity, and we are potentially hedging more in our stock and max growth. What we've found for at least the first 3 quarters of the year is that if we'd have placed a hedge the whole time, we'd probably be in the same position with less volatility. Now that's just this year, but if we get kind of a slow and steady uptick in the market, the hedge doesn't really hurt us. What hurts us on the hedge is a big, fast market recovery, big returns. You don't want to be hedged. Of course, you want to be hedged when the market's going down. So we're looking at potentially doing some of these hedging positions in our stock and max growth models in the upcoming months, maybe even this month. All right, so Q3 review, right? So the S&P 500, everybody wants to compare, the S&P 500, to everything they own, right? The top 500 US companies. The S&P 500 peaked on September 2nd at 4,536 points and then proceeded to drop to 4,300 by September 30th, over 5% drop in the month of September. The Ag Index, AGG, right? Bonds, they peaked on August 3rd at 116.58 and then dropped to 114.96 by September 30th. So bonds in the last 2 months are down 1.75. The bond index itself for the year is down about 2.71. The reason why, the bond index on the annual performance is not down 2.71 is because you do get a coupon, right? You're getting about a 2% yield. So you've received about 1.5% of those. So you're still down. But if you clip the coupon, you're still making some money. But if the bond is yielding 2%, but you're down 2.71, it's not a good place to be in with all the inflation we see going currently. Our outlook is still the same, right? We think we're in a secular bull market. They tend to last 15 to 20 years, right? We're in year 12. The S&P 500 is still the top performing index, although it did have a big drop in September. And I mentioned previously the 40-year bond bull market may be over. I think it's official. We can call the bond bull market done, right? We're going to be negative for this year. Rates are going up. The Fed says that, rates are going to go up sooner, maybe not faster, but there's going to be more rate hikes in the future. If you had, if you lost some sleep this last month in your account, like if you had the stock model or a max growth and you saw a lot of fluctuation, right? We have other options here internally where we can kind of take some more risk off the table, whether that being at Fidelity or Schwab, or, by using, a different index account, right? Using a different type of annuity potentially where you can't lose money, where you don't see those fluctuations. We're also looking at, we have some preferred stocks that pay dividends and don't fluctuate as much. So we have some different investments. If you're seeing yourself more worried about the market, right, we can take some risk off the table. So let us know if that sounds good. If you're, if you're struggling with kind of this market volatility, I think we're getting ready to have more and more volatility. We haven't really had that much this year, right? I haven't had a whole lot since March of last year. So we're going to see that creep back in, and it's going to be the new normal, even though we're feeling, a little bit uneasy with the last month or two, as investors, right? We're not uneasy here because we're used to them, but we look at data all the time. But if you are feeling that way, let us know. Let's have a conversation. Let's see if you're in the right profile from a risk perspective. Once again, I'm Luke McCarty. Contact us. Here's my email. Call Art. Here's our office line. Here's some disclosures about us, right? And thanks for joining. Let me know what questions you have and how we can help.